Uber shares falling sharply overnight. The company reporting a loss of $5.2 billion in the second quarter. The bulk of that includes costs related to its IPO. But excluding that, Uber's losses were still about 30% worse than in the first quarter. Revenue growth also slowing. Joining us now, Jeff Kauffman, Managing Director at Loop Capital, and Rett Wallace, CEO at Triton Research. Gentlemen, good morning to you both. Jeffrey, I'll start off with you. Down 8%. Is that warranted?
Probably not. But that will be the initial reaction. I think the headline is a miss on revenue, a miss on the bottom line. The reality is not only were there one-time costs related to the shares, but they also paid their drivers almost $300 million as a one-time benefit to employees. That was taken out of revenue. When you add that back to revenue, it actually beat consensus by 4%. And when you adjust for the IPO-related expenses, the bottom line actually beat expectations as well. And both Lyft and Uber commented on a more sensible domestic competitive environment, and both guided to better EBITDA numbers for the year by about $300 to $400 million. So this one took a little algebra. The headline looks bad, but when you dig beneath it, it was actually a beat on both the revenue line and the earnings line.
The comparison, though, that you just made between Lyft and Uber and their outlook for the U.S. market would seem to argue to be more in favor of a Lyft as opposed to an Uber, because if you take a look at where the weak spots were in Uber, at least for ride-hailing, it was Latin America. They're facing more competition from Chinese competitors. That's a growth market for them, and that was down more than 20% year on year.
Well, these are two different stories. Lyft is a domestic rideshare story. That was really good, 40% growth.
But maybe
when you look at Uber,
maybe you don't want to be in the international parts of the business.
Well, not necessarily. What happened in Latin America happened a year ago. We're just seeing the year-on-year impact of that.
Catch-up. Okay.
Right, you're seeing the catch-up. But when we looked also at Eats beat our expectations in that category. Freight was a little weak, but that was consistent with the freight market that we saw. So the brokers were all reporting weaker results. So when you look at the two, they're different bets. Uber is a bet on the global growth of personal mobility in any given market, in any given period.
What's the risk that Didi or somebody else jumps into that market? You get into, it looks like any time they're in a market where there is at least one competitor, it becomes complicated very quickly.
And one of the things we like about what they do is when they see that, they have gotten out of some of those markets and focused on other markets. So we only see about...
You don't want them to try to own every market at all.
We don't. And they've actually gone and partnered with companies like Yandex or Didi, where the competition was difficult. You've got regulators who are trying to slow down growth. But they're finding new growth avenues, such as delivery of meals to the homes. We think eventually delivery of grocery to the homes. So this is really a global bet in the case of Uber on the spread of the convenience economy, personal mobility. When you're looking at Lyft, it's more of a domestic bet on rideshare. So they're different investments.
So do you think that these companies are welcoming regulation because it's essentially providing a moat around the industry? So, I mean, being regulated isn't a bad thing if you're Uber, because you're making it harder for new entrants in your marketplace.
Well, there's pros and cons. And then there's going to be groups like the Taxi Limousine Commission here in New York that wants to keep the taxis as they are, so they're going to limit the amount of licenses.
Right.
I think the real big item for the industry in the long run is going to be the idea of robo-taxis, autonomous vehicles, and how that's going to affect things.
That's the big threat.
Right. On one hand, it's a competitive threat. On the other hand, it's going to lower the cost of transportation, so you probably grow the whole market. So there's pluses and minuses to each.
What do you make of the quarters, especially when you do the comparison now?
Just on the regulation, I got to get in there quickly. I thought that was the highlight of the call yesterday, is Dara basically going after Mayor de Blasio about not constructive conversations about how you integrate Uber into a total transportation solution that works for everybody. So what I heard at least was regulation is definitely a factor for them, but they want to be productive about it in a very long-term view so that the platform works for the most possible people. As far as the quarter as a whole, I think it was a yawn, right? The stock went back to where it was Monday. Like, it didn't matter, really. Whatever people were waiting for, this wasn't it. So the IPO wasn't really a big entry catalyst for people. Initiation of the sell-side research wasn't. First quarter results weren't. And this wasn't either. So we're still, if you bought it at 45.
What is it going to be then? Because Dara was very vague about the path to profitability, whereas Lyft was a bit clearer. Dara was not as clear in terms of the investment cadence over the next couple of years.
This is why I think people, again, didn't, this wasn't the buy catalyst in the sense that the loss profile is still $2.8 billion a year, right? They have 11 and change billion dollars of capital on the balance sheet, so it means they have 4-year runway to figure this out, and they didn't figure it out yet. So, if I'm thinking, like, which one of these names do I like? Lyft goes out of business first, right? And then at least they get the U.S. market. They're still going to have to fight everywhere else, right? But whatever it is we're waiting for to reveal the long-term profit vision of the company, it hasn't happened yet. And I think he was very clear about that. Like, we're still trying to figure it out because we don't know.
That's a long horizon.
It is a long horizon. I mean, my question back to you would be, did the Lyft quarter put in context, to Mel's point, I think, is that the reason why Uber might have had an outside move to the downside? Because the market's saying, wait a second, Lyft seems to have figured this out, whereas Uber's 4 or 5 years away.
So I just look at them the way they've traded over the last couple of months since the IPOs, and they're basically like still right where they were in terms of the discount to the IPO price, the range that they've traded in. So Uber moved up a little bit in the run-up, right, and then moved right back to where it was, but didn't go below that. I don't know where we are today. Is it below 40, right? We were at 38 on
I
Monday.
want someone to tell me how to value the company. That's all I want to know, and I don't know what the right answer is.
I think that's why so many people sat out the IPO.
Yeah.
Right? Like, we already own it. Most big investors owned it already. What should I pay for this in the long term? Unclear. Let's wait and see.